Hello everybody, Rick Powell here from the Powell Fine Host Group and Real Broker LLC. Today is Friday, January 27th. We're going to talk about a few things today. Number one, why the numbers you are seeing reported for Ada County or Canyon County or Boise County are not truly accurate, showing what's going on the ground as far as the actual values of your home, perhaps, as well as what's going on in the national trends that are going to influence what's happened this week and what's going to be happening next week. So let's start off first and foremost with what we are seeing in Ada County. I'm going to change over and do a screen share here real quick. And this is the year-end snapshot. It's basically December's numbers, and it's Ada County year-over-year comparison. So they're comparing December to the previous December. So in 2018, our year-over-year change over here was up 18%. 2019 was 9.9%. 20 was 13.9. 21 was the blowout year at 29.9. And then it says 2022 was up 10.9. That's December 21 to December 22. We're looking at year-ago comparables, all right? So yes, December 22 was up 10.9% over December 21. So technically, yes, we were up 11%. However, the reality is our prices peaked in May of 2022, and the median price in Ada County was about $602,000. Now it's down to $566, as you see here on the report we have here. And that's going to continue to go down. Every month is going to be distorted until we get to May. And then when we get to May, that's the true peak. So once we get into May numbers, which we'll get into June, the first, second week of June, then we can start really seeing where we are from the peak of the market. Every time you hear, hey, we're up this month, we're up that month, take it with a 5-pound grain of salt, because the reality is we're already down almost 12% from the peak that we had in May. Because that was 602, we're down to 566, and each month it's going to go down a little bit. There's an article we're going to discuss at the end of this. Fox Business News just came out saying that, hey, Goldman Sachs has reported that according to their analysis that 6 months from now, the market will be stabilized, the crisis will be over, and we'll stop seeing contraction in prices. We'll go through that in a minute. But I want to talk about Ada County right now. Again, going back to the report, 566 is what they're saying here, but you also got to take a look at our inventory. You can see at the actual home sales by unit, they're up and down and up and down. And there's a lot of seasonality. One of the nice things about being up here in Idaho is that, we do truly slow down in winter, where in the warmer climates, there's a little bit of seasonality, but it's nowhere near as pronounced as ours is, where it's peaking hard in July, and you're definitely hitting your ebb every January. So you look at our unit sales, they're coming down, and that's in direct relation to how high interest rates were. The interest rates peaked back in November. In November, I think, was 7.3 or something like that. And they literally just hit the brakes hard. Very few people were buying or selling a home. Well, plenty of people trying to sell. Very few people were executing a purchase simply because the cost of capital was too much when you combined with the acquisition cost of the house. So, that spike right there totally contributed to the drop down right here. Now, in another couple of minutes, we're going to talk about how that's changed in December. December actually popped up a little bit, which is nice to see a little sign of life in the market like that. But that's what we're talking about there. So as we're talking about sales and slowing down and everything else, what I'd like to do also is discuss some of what we're seeing in the new homes market. Like we're actually seeing, I got this email a couple days ago. This is an entire subdivision. And now this one is what's called fully entitled and buildable. What that means is they've had all of their permits pulled. They got all the approvals needed to literally start moving dirt, laying foundations, and building homes. So you got here, it's up in Weiser, which is northeast of Ontario. It's right at the Oregon border, and it's probably 30 miles northeast of Ontario over on the Idaho side. They want $3 million for 8.6 acres, 38 lots, but again, it's fully entitled and buildable, meaning this one's ready to go, but this builder has decided to sell it as is, as opposed to committing the capital to the starting the builds and everything else, because it's quite expensive to build one. So here's another one. This is over in Middleton, a lot closer to Boise, over on Highway 44. You've got $3.6 million for 13.5 acres and 40 homes. Now, this one's only got pre-approval. They have not gotten their permits. They're not totally ready to build. They've basically just sent the plot and the overall concept to the city. City's given pre-approval, but you still have to do your engineering, and there's a few more steps before you get to the point where you can build on that. But this is kind of cool that we're seeing these things pop up, and we're also seeing a couple of the larger builders that have huge tracts starting to sell off some of the lots within that to small independent builders, but ones who will keep the build quality and the flow, and everything will feel the same. So you won't, 2 years, 5 years, 10 years down the road, when you drive through the neighborhood, You'll see different elevations and different styles, but it's not like you have $1 million houses sitting next to $400,000 houses. Everything will be consistent in the neighborhood, which is a very good move on their part. Moving on to January interest rates. This just popped up on CNBC a couple days ago, and it's talking about mortgage rates are at the lowest point since September, which is always a very nice thing because, quite honestly, the mortgage rates are what's going to be the biggest driver in the market for the next 12 to 18 months. Inventory really matters too. That's a whole different conversation, and inventory is still historically low. I'll touch on it just a little bit in that any given year, 60 to 65% of the home buyers are going to be home sellers, meaning they've got to sell their house to buy their next house. And right now, just about anybody who owned a house prior to the end of summer of 2022 has refinanced, and they're certainly below 4%. And quite honestly, most of them are in the 3.25 to 2.75 range. I know a couple of clients we have that are in 2.5 range. So if you have a sub 4% or even better yet, a sub 3% home loan, the mortgage that you're currently dealing with now, why would you go through the effort and cost of selling your home with its lower rate, commit to something with a 6+, right now I think like 6.3, 6.4 on the mortgage rates. So you're almost in effect doubling your mortgage rate so you don't have as much buying power. Why would you do that? Most people aren't going to. They know what their house cost is on a monthly basis. The interest rate isn't changed on a 30-year mortgage. Your insurance will fluctuate a little bit. Your property taxes will fluctuate a little bit. Other than that, you know how much your housing cost is going to be. Unlike rent, unlike APRs or adjustable rate mortgages, ARMs, and things like that. So we're not going to see a flood of homes coming in the market, which would accelerate the erosion of prices in the market. Pricing is going to remain relatively stable. And as the interest rates come down, you'll have more buyers coming in, and that's going to put a floor under it. So that's going to help. But right here in January, last week, purchase mortgage applications jumped 28%. That was the highest jump and the highest number that we've had since September because the rates really started going high. They broke over 6 back in September, and by November they were over 7. That really chilled the market. So as it's coming down, we're seeing all the pent-up demand, all the people who have been on the sidelines for the last 6 months jumping in, which is a nice thing to see. So this is good. Signs of life are always happy to see. Let's talk about a little bit the downside. What if there is a big recession? What if we have, we just saw Google let 12,000 people go, Twitter let 3,500 or 4,000 people go. There's a lot of layoffs happening in the tech sector, which is not good because a lot of those tech people help drive the markets like here in Boise or Austin or Phoenix or San Diego or some of the other places where they moved out of the Bay Area to other places that they thought they would like living at better from a quality of life standpoint and a cost standpoint. But if those people lose their job, are they going to be able to find another job that works remotely? Or are they going to have to go back to the Bay Area to find something there? Nobody knows. We'll see as this shakes out. But right now, according to Freddie Mac, the serious delinquency rate for mortgages didn't change in December. And right now, I think there's 0.7. Yeah, let me pop this up real quick. Yeah, there's the 1.0 line. You can see that back in January of 10, during the Great Recession, they peaked, they were north of 5%, almost 5.5%. Then after the pandemic, they popped up again. Now, a lot of those went into forbearance where they were given a 6-month or a 1-year window where they didn't have to make any payments. But then they came back and they made up all the difference. And most of those people, they're out of forbearance, the program they had, and they're back in. So right now, we're back into basically the pre-pandemic rate that we had, which is fine. I think it's going to spike a little bit over the next year for a couple of reasons. Number one, you saw the tech layoffs. Some of those people are not going to be able to find jobs that pay as much as they were making at Google or Twitter or something like that. Number two, there were a lot of protections put in place during the pandemic to prevent evictions or foreclosures or anything like that. Those are all gone. And there were certainly a group of people who were in trouble before the pandemic. And even though there was a lot of relief money and everything else going on in the pandemic, if those were behavioral issues, meaning they never managed their credit or their money very well, and they were protected for 2 or 3 years where they couldn't have an eviction or a foreclosure or anything else, and now all those protections are gone, they're going to get evicted. So I think we're going to see a slight spike from that coming up, but I don't think we're going to have an overall huge issue with this, simply because the credit profile of the homeowner today is so much better than we had back. If you go back to the Great Recession, you look back in here in this section right through here, the liar loans were everywhere. They didn't check your FICO. They didn't check your income. You could just say, hey, I make $1 million and I have an 850 FICO. And they say, okay. And they fill out the box and you get the loan. No problem. Nothing like that right now. If you get a loan today, you have to actually be qualified. You have to have the income, you have to have the FICO score, you have to have the reserves. And if you don't have those three things, you're not getting a loan. It's that simple. Homeowners right now have massive equity. They're in a great position there. They have great credit and they have good income. And, savings have been coming down every month. Inflation is part of that. Plus the fact that all the pandemic money's going away too. That didn't help. So we're not in any kind of critical situation with savings, but those are coming down too. They're not as strong as they were, but the equity is still in a great position. Because even if we give up 10 or 15% nationally on home values, you basically just lost to 2021, or 2022 rather. So you would still have wherever you were at the end of 2021. So everybody has enough equity to give up some without getting into a critical situation. And the biggest difference between today's market and the 2008, 9, 10 market is that there's none of the liar loans, or Washington Mutual called it pick a payment. Countrywide Mortgage had a different name. But basically you had the ability you could pay your full payment, you could pay interest only, or you could only pay half of your interest. The problem with paying half your interest, though, is that half you didn't pay got rolled into the principal of the note, so your loan actually grew in size. Once it grew to 125% of the original loan amount, it automatically got recast into a 30-year fixed mortgage. You did not have any more options. You had to pay the full note. And we saw people with their payments going from $2,500, $2,600, $2,700 a month to well over $7,000 or $8,000. And they certainly couldn't afford that. And that's how they lost their houses. And that's where the flood of foreclosure homes came from. We don't have that right now, so we don't have that issue. Home sellers are basically on strike right now because they don't want to give up their 3-point or less mortgage for a 6-point or more mortgage. So until there's a serious reduction in interest rates, we're kind of at that impasse right now where prices are going to go down a little bit, but not a lot. And buyers are just going to wait until they find a good opportunity. Okay, that's about all the time we have today. Thank you for watching. If you have a topic you would like us to address regarding real estate, please let me know. You can either drop it down in the comments below. You can send us an email at sold@powellfinehomesgroup.com. You can send me a text or call me at 208-872-8108. And we'll be sure to go ahead and get it included in the series, and we'll let you know when we post it. So thank you very much. Be sure to subscribe to our channel. That way you also know whenever we post something else. Like our videos and add any comments you want. We'd appreciate it. We'll see you next time. Thanks so much.